Sarat, it's great to have you here. Man, this is, as always, a difficult market environment. So industrials, let's start there. A couple of names that you like, name you don't like. Why do you think Uber's a buy and the right stock to own right now?
So I think when you look at it, what does Uber have that other companies are not going to have? They're going to have pricing. What they have right now are a couple of products, whether you have mobility and delivery. 46% of their customers use both on a multi-product platform. They're also in freight, and they've got these other businesses going like advertising. And I think the technology operating leverage that Uber has going forward, that's what you really want. Pricing power, operating leverage, where they can pass this on to the customer, and the customer will take it because they know, look, what are you going to do? Drive your car? Cars are getting more expensive. So when you look at the alternative, variable costs for the customer and higher margins for a company like Uber.
Yeah, well, and there it is, 34.66. We could get into a whole debate about Uber, but I want to actually maybe save that for Trex, which is the name that you would not be a buyer of here. And the industrials, love to hear why this one to you is a no-go.
So if you look at the stock chart and you look at kind of what they've done for the last 2 years, it's a pull forward of demand for the decks and railings that they've had. They've used composite material. They've been able to have pricing. Well, what's happened now is that the stock is at 32 times earnings. Pre-COVID traded in the mid-20s. Its EBITDA multiple is at 21. It was, again, mid-EBITDA multiple before. What's also happened is you've got 4 or 5 competitors now coming in with similar products. So pricing is actually going to come down. And then you add to it, if we're kind of at the tail end of COVID, well, the demand for goods is going to come down and services is going to increase. So all this kind of comes together and says, do I want a company that's not going to have pricing, that pretty much had pull forward peak earnings, and do I want to be in this area versus somewhere else that I can get pricing on?
All right, Sarat, this is interesting because if you look at those particular industrial type names, I can kind of understand how you look at the valuation side of things and take a look at the product portfolios. The product portfolios are key when it comes to healthcare companies, especially drug stocks, pharma companies, biopharma, anybody, biotechnology in those particular industries. They're all relative underperformers. Are there places, though, that you want to buy or sell because of those valuations and most importantly, maybe product pipelines?
So a couple of those things, Dom, are very important. Valuation and product pipeline are very important. So you look at a company like Bristol. Bristol merged with Celgene. They still have about $2 billion of cost to take out. It has an over 3% dividend yield. They're buying back shares, and their pipeline is not just focused on one drug. And that's why this stock is now today so cheap, because it's a portfolio of drugs that if they come out, which we think they're pretty comfortable with, you're going to get single-digit revenue growth, which is huge operating leverage. And really, the drug stocks have not performed in the last couple of years, and they do have pricing, at least if you've got good drugs in your pipeline and you trade at 1/3 or 40% of the market multiple.
What about then Biogen? Because that's one that's really underperformed, though, over the course of the past year.
It has, and Dom, if you look at it, they just had an Alzheimer's drug approved, and there's a lot of controversy over this drug. Will it actually do what it said it's going to do? And more importantly, will the CMS actually give it the pricing it needs? Because they really need that pricing. So this stock's trading at almost 14 times earnings, but with a declining revenue potential. And also, most of their pipeline, unlike Bristol, is very new drugs. So they're very early stage. So when I look at kind of where I want to allocate the capital, I want to put it to companies that are almost there and the market's not giving you credit. So a Bristol and an Uber are show-me stocks, but I think the cash flow behind them and the earnings power, those are ones you want to own going into an inflationary period where pricing is going to be really important and product is going to be really important.